What's up, YouTube? In this video, we're going to go over Nike and a little bit of Footlocker. And disregard the raspy voice. I got a little bit of a cold today. So Nike, it's been in the news. It's been getting beaten down quite a bit. Year to date, down 12.7%. Or sorry, over the course of 1 year, down 12.7%. Year to date, 16.7% down. So, Footlocker, a big driver of what seems to be Nike's lower price action. So they're down 54% in the year to date, 53.5%. So the big driver here is Foot Locker and Dick's have been reported pretty poor earnings, really. And it's leading to Nike, a correlation to Nike. So Foot Locker actually, they their dividend right now is 9.3%. They're eliminating that. That's how bad their earnings was. So I'm like, okay, we'll pop over that in just a second to see their earnings report and see what's going on over there on Foot Locker. I want to know what percentage of Foot Locker is Nike. So I said, okay, I just want to take a look at their inventory or whatever, their new arrivals, real quick. I'm like, okay, yeah, Nike, Nike, Air Jordans, Nike, 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 Nike. Okay, so a lot of Nikes here, right? Then I Googled, I'm like, okay, well, let's find out. And it says 70% of Foot Locker's sales is Nike. I'm like, okay, so that correlates to Nike quite a bit then. It's not a big dent in Nike, but based on their based on Foot Locker's total sales. So I want to come over to Foot Locker real quick and go really briefly through their earnings report and right in the first little box here, pausing dividend to enhance flexibility. Yikes. Okay, keep going. Gross margin is declining. Increase in promotional activity to for advertising, and they say that's part of the reason for their gross margin decline. Okay, and then I think they added this in after seeing the other couple retailers say that they had a higher shrink. I don't know how frequent people steal from Foot Locker. I feel like that was just added in, being that it's at the end of the sentence. Um, and we'll keep coming down here. Let's take a peek at some of their financials here. So, income from operations this quarter, they made $1 million. Um, keep going. Let's see here, right here. Their balance sheet, they have $180 million of cash on their balance sheet. They have $940 million of short-term debt that's got like typically 1 year, 12 months, and $766 million of long-term debt with a total of $1.7 billion of debt. And that's with me crossing out their long-term debt obligations too. I'm, you know, they can liquidate some things over here. Like they got merchandise inventories, which you're not going to get if you need to liquidate or get rid of. Like it's not going to be $1.8 billion. It's going to be half that probably. They're probably going to do a 50% markdown just to get money on the table to pay for some of their debt. So they're probably going to reduce their inventory by cutting, putting on like a sale, like 25% off, 50% off, back to school sale, something like that, to try and get some cash back on the balance sheet here to pay for their short-term debts, right? So that's my assumption what they might do. So keep going. Their net income, this is over a 6 month, well, this is year over year, but down 86%. Not good. Their cash burn with their net cash used in operating activities and their capex in 6 months is $290 million cash burn, $150 million per quarter. They've got $180 million left on the balance sheet, so they basically have 1 quarter left. and their let's see here, their dividend payout is $75 million. That's not going to help them all that much, really. $75 million when you're burning through $150 million. I mean, I guess it's half of it, but I mean that's not even included in this cash burn here. So, it's I think Footlocker is on the verge of bankruptcy. If this keeps, if they have one or two more quarters like this, I think they are in, they're they're gonna file for bankruptcy. So that's my real quick take on Foot Locker. I haven't done a real big deep dive on it, but just glancing at it, they're not heading in the right direction whatsoever. They completely eliminated their dividend, which I think is a huge part, not only the balance sheet, but I think is a huge part as to why Foot Locker's stock has just gotten beaten down on, because their dividend is no longer 9%. So I think that's a big deal for a lot of people that are dividend investors. So let's hop over to Nike. Nike, Q2, or sorry, Q4. So they just finished off their year. Um, so they looks like they burned through about $2.3 billion of their cash. Um, they used it for share repurchases, dividends, capital expenditures. Um, if they burn through cash to grow the company, that's one thing. To use it to buy back their shares and pay their dividends, it's not good. I I personally I don't want to see that. I would like them to rather say we are burning through $2.3 billion in cash because we're bringing out a new product line or something like that, or versus saying, "Oh, here's $2.3 billion back to the investors that comes off our balance sheet." Like it's not like they just maintained $10.7 billion; they reduced it. So not ideal. So their dividends here, share repurchases of 1.4 billion. So they bought back 11.5 million shares. I believe they're using excess cash to buy back their shares. What it kind of says it right there. Gross margin reduced by 1.4% due to freight costs. So temporary, probably. That's probably already been, you know, somewhat fixed, maybe. So their net income, let's see here, year over year is down 28%. I don't know. The cash, they got $10.7 billion in cash on the balance sheet. They have $8.8 billion in short term debt, $12.5 billion in long term debt, with $21.5 billion in total debt. So they're like you know, eh, you'd like to really see more, especially for like a blue chip company like this, to have a lot more cash than that to cover their, at least have it offset their debt a little bit more than that. So we'll come over to the valuation spreadsheet on Nike. So you got a ticker entered in. They have a 20, call it 21% return on invested capital. That's great. Future growth rate, based on analyst, is 15.6% on EPS. They currently pay a 1.38% dividend. Um, Forward uh, revenue growth is 22.47. That gives us down here Peter Lynch fair value of $50 per share. Multiples. I'm going to remove this one because of the insane PE on this one, because I feel like that's not realistic. Um, so once I remove that, it gives us a fair multiples market value of $46 per share. Come down here to manual PE. It takes about 27.6 years for Nike to reach its trading market cap. Which come over here, multiple over 25 is overvalued. Price to book ratio currently trading at 9.63 on the price to book. The average, let's double check the average on Nike. So Nike trades on an average of 15 price to book ratio over the course of 5 years. Peg ratio 4.37 today. Forward looking 3.21 peg. Grams valuation over here. Um, Current AAA corporate bonds is 5.1. Intrinsic value of $67 per share. Seeing a common theme here. Come over here, DCF. We have our weighted average cost of capital. Type in all of our numbers here for Nike. These are the most recent numbers. Gives us 8.46% weighted average cost of capital, 2.5% perpetual growth rate, 12%. Analysts predicted 12%. Average growth rate was 52%. I went with the analysts because of the future outlook. I think 12% might even be a touch high. And here's their free cash flow. Speaking of which, on their balance sheet, when we looked, they did not break down their free cash flow. Must be on their 10Q, but their 10Q is not out yet. So the free cash flow for 2023 was $4.8 billion right here. You can see that. So overall, their free cash flow, obviously disregard 2020, is growing nicely, but it declined by $1 billion between these 2 years here. And then come down here. So this autofills gives us a 12% growth rate of their future free cash flow. Cash and marketable securities was $10.7 billion. And all this other stuff. Autofills as well. Shares outstanding. They have 1.5 billion shares. Gives us a discounted cash flow per share of $75. Finally, we come over here to our Rule of 72. Current EPS 3.23. Lowest EPS growth rate was 15.67, so I'll use that for our future EPS growth rate. So 15 goes into 72, 4.6 times. 4.6 times goes into 10 years, 2.17 times. So we're going to double our earnings per share 2 times over. So from one double to two double is a 12, it was basically 13. I gave it a 14 to incorporate this extra little bit there. And it gives us a fair value of $109, 30% margin of safety of $77 per share. So then over here, the summary of all these multiples, all these valuations is average price of all of them is $70.59 per share. Purchase price with a 30% margin of safety is $50 per share. So positive cash flow, strong share buyback program, always nice. Stable company with a strong track record, plenty of cash to cover their debt for short term, not their long term. Concerns burning cash reserves to buy back shares to pay out dividends. Um, yeah, I don't like that. Forward growth is mid to high single digits. Again, it is a blue chip company, so the growth rate on those are not going to be 20%. They're going to be lower percentages like that. It is currently overvalued, even with a pullback based on the past and today's fundamentals. So, real quick, obviously make your own assumptions on what you think of Nike. I think Nike's got some headwinds ahead of it. I think there's going to be they're going to have to make some changes to their finances, I believe. I mean, they don't look like they're headed in the right direction, but they can probably easily correct them like that. I don't know. We'll see. So that's kind of my take on Nike. It's one of the it's going to get beaten down personally. I think more based on the chart pattern here. We'll come over and we see here on Nike we're in this sort of like a cone type channel. I mean, just kind of keep trading between this and yeah, sometimes we break out. Obviously, when everything was blowing up in terms of valuations, everything was so overvalued. This is what happened with everything, but for the most part, we've been inside this channel. And based on the fundamentals here, I think Nike has every bit of room to come back down to about $80 a share. And then if things kind of don't get too much better, I could definitely see this thing coming back to fair value of about $70 a share. And maybe even in this range, this support range. I could truly see Nike coming back to about $65 a share, retesting this support range. And then like I said, I think I'd probably be a buyer here at $65 a share, and maybe this thing trades back up to, you know, in this $100 range, something like that over the course of time when it kind of corrects and their fundamentals start to look better. Start making instead of burning money, they're adding money to their balance sheet and stuff. So there's some things that need to get fixed at Nike. It's not going anywhere, but they definitely need to change some things around, in my opinion, to make their balance sheet look better and make their stock look more attractive. They've got Foot Locker's not helping them whatsoever, obviously. But so that's my take on Nike. Let me know down below what you guys think of Nike, what you're doing with Nike. Also, let me know down below if you'd like me to do a valuation analysis on Foot Locker to maybe come up and figure out where Foot Locker might be headed. Like I said, I haven't put any of their numbers into the spreadsheet to know what Foot Locker has in store for it, but we can probably definitely figure that out. But that's it for this video. Please like and subscribe, and we'll be back soon with more.